For more on what New York Community Bancorp's lifeline means for the battered stock, let's bring in Chris McGratty, head of bank research at KBW, a Stifel company. Chris has a market perform rating on the stock and outperformed not too long ago. And Chris, I want to just start off with where we left it. You know, if New York Community Bancorp had never acquired the assets of a Signature, would we have known about the problems within their loan portfolio?
Sure. Thanks, Melissa. The problems in the loan portfolio really come down to concentration, right? New York Community has been a concentrated business model in New York City in multifamily apartment buildings forever. That's not new. The Signature deal and the Flagstar deal a year ago actually made them less concentrated, still concentrated, but less so. Really, the issue is they crossed the $100 billion level. And the OCC, while they're previously were the regulator, we believe the scrutiny got turned up after the deal. And certainly this phase-in period did not happen.
So was that when the bank announced that it was acquiring those assets, did you think that there was a phase-in period? I'm wondering how there is a misunderstanding about that when you're buying assets and it's a deal that's blessed by the FDIC.
We all did, yeah. We actually upgraded the stock to outperform that night. We thought at $6, given the stock and given the capital relief, this was a great deal. We thought while the company had earnings challenges they were working through, diversification was moving in the right direction. So the phase-in period didn't happen. And certainly we didn't see this. We stepped away from the stock in December, but we certainly didn't see the speed at which this happened transpiring.
So, Chris, it's Karen. Thanks for being on today. So you have a buy on the stock. What is it? How do you model this? What are you hoping they achieve? What are you basing? What kind of metrics are you looking for here?
No, just to be clear, we were buy rated last year. We stepped away in December. So we're market weight the stock. Really, what we're going through, Karen, is we're trying to figure out with all the dilution that happened today, what is the normalized return on equity for the company? The stock closed at roughly 50% of pro forma tangible book. And that would suggest the market's thinking an ROE in the 5 to 6% range is about right. We're hearing and we're talking to investors a lot about this reminds us of Citigroup from 2008 and the dilution. So the earnings power has certainly been diminished. There is earnings in this company. It's going to take time to come out. And I think today was the capital raise. But going forward, they're not done. They're going to sell assets. They're going to consider securitizations. Those were ideally going to be the first moves the company was going to make after earnings. The market forced their hand to do the equity raise first. But clearly, we're trying to estimate what the earnings power, and it's probably a 5 to 6 ROE.
Hey, Chris, it's Tim. So who's next? Because you can't tell me that idiosyncratic. I know the New York rent control market's difficult. We can all paint that picture. But it was a year ago that was SVB. It was held to maturity securities and a quick flight of capital that made that a problem. There's some issues out there, and it just seems to me that there are a lot of people that may be over their skis.
Right. Commercial real estate's a big asset class, right? It's 40% roughly of a small bank's balance sheet. So the smaller banks, Tim, have more CRE. So that's where we're spending the focus. And they have lower reserves. So the incremental earnings pressure is going to be felt for the small banks. But if you step back, today was a big step in the right direction for the industry. Confidence has been really, really low. I think investors had feared this was going to be a zero for shareholders. And clearly right now, that's not the case. So we are still thinking about what the normalized impact from credit is. But we don't think there's going to be a systemic concern from here. We've had a year. We're almost at the 1-year anniversary of SVB. The industry's liquidity and deposit levels look very, very strong. There are earnings pressures, but systemic, we don't buy into that.